Welcome back to The Deep Dive. Today we are taking a granular look at the recent earnings call for LightPath Technologies, ticker LPTH. We're covering their fiscal Q1 2026 results. And, this isn't just about the last 3 months of activity. This deep dive is critically important because it confirms whether a multi-year pivot strategy is actually working.
It's a key moment. It really is.
Yeah.
For years, LightPath was, primarily known as a component supplier. They sold optics, lenses, glass. But the whole strategy has been to move up the value chain to become a vertically integrated provider of complete, high-value infrared optics and camera systems.
Right.
So these Q1 results, they provide the first real measurable evidence that this inflection point is happening. It's confirming the investment thesis, really.
Okay, let's unpack this then with the headline figures that immediately sent a pretty strong signal to the market. The core message here is growth and momentum. LPTH delivered a substantial revenue beat. They reported $15.1 million. That comfortably exceeded the consensus expectation of $12.66 million, which is a significant 19% beat. But more importantly, it represents a massive 79% increase year over year. That's acceleration.
The top line growth is certainly accelerating. Now, when we look at profitability, the initial reaction might be a little mixed if you just look at the statutory accounting numbers.
Okay.
GAAP earnings per share still came in at a loss of -7 cents. Now, that did beat the consensus loss estimate of -9 cents, but here's the critical operational metric that tells the real story of the quarter, and that's adjusted EBITDA.
Right. And for those who might be less familiar, adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization. It's a measure often used to filter out accounting noise and just show the underlying cash performance of the business. So what did it tell us this quarter?
It told us the business is fundamentally stabilizing. Adjusted EBITDA turned positive. It was plus $0.4 million. And that is a huge, necessary swing from the loss of negative $0.2 million in the prior year period. That move into positive territory indicates that the business model, despite all the heavy investments they're making, is starting to support itself.
And that momentum is clearly driven by customers demanding their new product line. If we look at that 79% revenue increase, you can really see the strategic pivot in the sales mix.
Absolutely. The assemblies and modules segment is the undeniable primary driver here. Revenue from those higher value, more complex systems grew a truly staggering 436% year over year to $5.9 million.
436%.
I mean, think about that. These higher value systems now make up 39% of their consolidated revenue. That's up from less than 15% just a year ago. This is the company achieving its goal. They're moving from selling simple lenses to selling entire subsystems.
And what's interesting is that the increased demand for their new systems didn't cannibalize their existing component business, right? Even the legacy segments showed strength.
That's right. Infrared, or IR components, grew 63% to $4.3 million. And even visible components grew a very respectable 16% to $3.8 million. It just shows that the overall demand environment for optics, particularly in that IR space tied to defense and security, is just exceptionally robust right now.
But wait, okay, if these new assemblies and modules are so high value and represent the future, we need to address the gross margin. It actually compressed this quarter. It fell to 30% from 34% a year ago. If the company is moving to higher value products, shouldn't we have seen margin expansion already? That feels like a point of concern for investors.
That is a very fair point, and management did address it head on.
Yeah.
They explained that the compression was primarily due to certain high-margin, non-recurring end-of-life orders that rolled off from the prior year.
So one-offs.
Exactly. They were one-off, high earners they aren't replacing. And crucially, they emphasized they are confident that margin expansion is back on track. They're targeting a 35% gross margin by the end of fiscal year 2026. That's as these new assembly orders scale up and they gain efficiency. So it's a temporary dip, really, caused by an accounting comparison. But the pressure is now on execution to hit that 35% goal.
And speaking of investment in accounting, let's revisit that GAAP net loss of negative $2.9 million. I mean, that can sound scary next to a positive EBITDA. What was the core cause of that loss?
Well, that loss ties directly back to necessary upfront investment and acquisition costs. Operating expenses, or OPEX, climbed 66% year over year to $7.0 million. That increase was driven by two factors essential to the pivot.
Right.
First, the ongoing integration costs of the G5 acquisition. That's what brought the camera systems capability in-house.
Right.
And second, increased sales and marketing spending to push those new fully integrated systems.
So we're essentially looking at a non-cash accounting artifact.
Precisely. The OPEX spike included a significant $1.2 million fair value adjustment for the G5 earnout payment. Think of it like a business building a new factory and booking all the construction costs immediately.
Okay.
It costs money up front, but it's essential to handling massive future orders.
Yeah.
So the gap loss is largely tied to this investment expense, which is why the positive adjusted EBITDA gives a much clearer picture. They're spending money to prepare for scale.
That brings us to the core of the differentiation story, which management emphasized repeatedly. The pivot isn't just about selling systems. It's about selling systems built on proprietary technology that resolves major supply chain risks.
This is where the story gets really unique. The key is their proprietary material, BlackDiamond chalcogenide glass. This material is licensed exclusively from the U.S. Naval Research Laboratory. And it is a fundamental game changer because it allows them to replace the industry's long-standing reliance on germanium in their infrared optics.
Germanium, which of course became front-page news when China imposed those export restrictions, they control a huge portion of the world's supply.
Exactly. That move instantly exposed the fragility of the Western defense and industrial supply chain for thermal optics. So BlackDiamond offers immediate resiliency. It's a domestic source. But it's not just a replacement. It's a technological leap. Chalcogenide glass is lighter, allows for smaller optics, and it offers better throughput. So the cameras perform better and cost less to produce in volume.
So if BlackDiamond is the key material advantage, the G5 acquisition is the vertical integration advantage.
That's the perfect synergy. G5 was already a leader in long-range IR cameras, but like every competitor, they're reliant on germanium. So now LightPath is actively redesigning G5's systems using BlackDiamond. This positions them as the only pure-play company offering fully integrated germanium-free IR systems manufactured entirely within the Western supply chain.
And this differentiation is clearly resonating with defense and industrial surveillance, as you can see from the massive growth in the backlog.
The backlog narrative is maybe the most convincing data point. Management commentary pointed to a backlog of around $86 to $90 million exiting the quarter.
That's huge.
I mean, to put that in perspective, that's more than 4 times the size of their backlog from just a few quarters ago. And the quality of this backlog is even more important. Over 2/3 of it is now in those higher value systems, validating the whole move up the value chain.
And that backlog isn't just a theory, right? It includes significant multi-year contracted revenue.
It does. They recently announced over $40 million in specifically contracted revenue. That's broken down into an $18.2 million order for 2026 delivery and a $22.1 million follow-on for 2027. This gives them multi-year visibility.
Okay, so let's delve into those specific high-value programs.
A key part of the backlog is for counter-UAS applications. And just to clarify for our listeners, we're talking about targeting the new generation of military and industrial drones.
Right.
Over $15 million of the current backlog is specifically dedicated to these defense needs. And that is a massive growth segment.
And the company also announced a strategic investment that seems directly aligned with accelerating that drone focus.
That's right. They noted an $8 million equity investment from Ondas Holdings and Unusual Machines. These are key partners in the domestic drone ecosystem. This investment is aimed specifically at accelerating their development of uncooled infrared solutions for drone applications.
So a strategic partnership.
It validates their technology and provides immediate cash to scale production for this specific high-growth market. A very smart move.
Beyond immediate defense, the border surveillance opportunity sounds like it could be extremely material.
It could be huge.
Yeah.
The company currently services 2 of the 3 main border tower vendors. Management noted that with over 1,000 new surveillance towers planned, they expect to win placement in the majority.
And these are high-value systems.
Very high value, potentially running between $150,000 to $250,000 per camera. So this is an extremely material and sticky long-term business for them.
But the highest profile catalyst, the one with the biggest revenue potential, remains the collaboration with Lockheed Martin on the next generation Stinger replacement initiative, or NGSRI.
NGSRI is the giant prize. This collaboration is a crucial future opportunity. Management reiterated on the call that if LightPath is selected and that program moves to full-rate production, it could represent an astonishing $50 to $100 million of annual revenue.
50 to 100 million annually.
Annually, yes. They did note the timeline for selection has been slightly delayed due to a competitor's testing schedule, but their confidence suggests they view it as highly probable. And they also mentioned having roughly 7 to 8 other large programs in the pipeline beyond NGSRI, with the potential for over $10 million in annual revenue each.
So with a record backlog and all this visibility on future contracts, the execution risk moves from winning the contract to actually delivering the product. Scaling production becomes the immediate priority. What are they doing to handle this volume?
They are executing physically and immediately. Management confirmed they are moving into a much larger facility in Texas next week. This expansion is specifically to support the immense production volumes needed for the NGSRI program. And critically, the cost is being shared with Lockheed Martin.
No. That is a huge vote of confidence from a Tier 1 defense prime.
The massive vote of confidence. And they are also vertically integrating production. At their Orlando facility, they're adding capacity for BlackDiamond glass manufacturing. And for the first time, they are integrating and testing the G5 cameras in-house. This vertical integration is crucial. It tightens quality control, reduces risk, and maximizes throughput. And you see this focus reflected in the new leadership they brought on, including the new VP of Manufacturing and the appointment of Mark Cow, former Northrop Grumman president, to the board.
It's important to recognize that the market has already reacted strongly to this transformation. LPTH materially outperformed the major indices over the last 3 months, up 116% versus the NASDAQ Q's 8.9% gain. And over the last year, it was up 402%. Investors are buying into this story.
The market is clearly rewarding the successful transition from a low-margin component business to a strategic systems provider that is solving critical supply chain issues for major defense contractors.
So what does this all mean for the interested investor? Let's transition to our high-risk, high-reward segment. And remember, this is analysis, not financial advice. But if you were pitching a highly focused trade idea based purely on the huge concentration of value in future program awards, specifically that binary NGSRI outcome, how would you structure a bet?
Well, the story here is purely about execution and realizing the backlog's potential. That NGSRI opportunity, 50 to 100 million in annual revenue, is so large relative to their current quarterly run rate of $15 million that securing it would cause an immediate explosive repricing of the stock. It's a binary bet.
And for a binary bet like that, standard stock purchases often don't provide the necessary leverage for a smaller investor.
Exactly. Options are ideal here. They offer defined risk and maximum leverage. So my outrageous but plausible trade idea would be to construct a deeply out-of-the-money long-term call spread. You're betting that the NGSRI award decision will be known within the next 2 years.
Okay, so walk me through that specific structure. How does it work?
You structure the spread by selling a near-money call option. It's an option slightly above the current stock price. You collect the premium from that sale. Then you use those proceeds to immediately purchase a much higher strike call option, say 2 or 3 strikes above the current price, with the same long-term expiration date.
I see.
This structure dramatically limits your downside cost. Sometimes it makes the trade net zero or even a small credit. But it gives you massive leverage if the NGSRI contract is secured, causing the stock to rapidly cross the strike price of your purchased option. It's a clean, capital-efficient bet purely on management, converting the single highest value opportunity in their pipeline.
That is a pure focus on the realization of value, not the current gap figures. To summarize this deep dive, the story for LightPath Technologies is clearly defined and accelerating. They are moving from components to systems and from germanium to their proprietary BlackDiamond. The execution against the record backlog, particularly that scale-up in Texas, is the defining variable moving forward.
And this leads us to the final provocative thought for you to consider. Given the extreme U.S. defense supply chain fragility that was exposed by those germanium export restrictions, will domestic alternatives like BlackDiamond soon become mandatory rather than just optional for all new critical defense programs? Because if the Department of Defense mandates domestic germanium-free solutions, LightPath's product moves from being a technological alternative to a must-have strategic asset. And that fundamentally alters its competitive landscape and its valuation floor.
A fascinating implication for strategic investing. Thank you for joining us on this deep dive. Just a reminder, everything discussed here is for informational purposes only. Consult your own financial professional before making any investment decisions.